Hey, hello friends, this is Martin from Secrets, the channel for learning about trading and investing. Welcome to Markets. Next week, the weekly stock market analysis show where we look at what happened in the week in the stock markets and then try to learn something from it and also plan for a better trade for the next week. And this is analysis for the week that's starting from February 6, 2023, Monday, tomorrow. So let's get right into the charts first, and then it's weekly charts of the Nifty and the BankNifty that you see here. And look at this candle; it's a wide range, bullish candle on Nifty as well as the BankNifty. Very wide range, and look at the volatility that happens. Remember, it was a budget week, and it's also a bear trap. The bears who thought that it's going to crash down were trapped. So it's a bear trapped. Wide range bullish weekly candles that you're seeing, and it's almost a piercing pattern. You can say it's a piercing pattern. Has to go down and then go up more than 50%. So that 50%, I have a doubt whether it's happened or not. I have to the same. Anyway, piercing pattern does indicate there is a big outbreak up more that can happen, but this is not exactly. No, it's almost there, but it's not exactly a burst pattern, right? But definitely it's a clear bullishness that's evident from the bounce back that is on the BankNifty, and that has happened from a support zone. Several support zones, 200 day moving averages is there right there. BankNifty is quite the bounce happened much before that, but on the Nifty it bounced from there. And Fibonacci 61 retracement level from the low swing also is at this zone from where it has bounced up on both indices. So clear bounce up has happened, indicating a bullishness. A bullish move, but we are not yet to have any confirmation of that yet from candlestick patterns as well, because if you look at the lower high, it's out here. That's about the 18,200, and understand that 18,250 kind of levels are clearly conquered. We cannot say that the bearishness has ended here and has found a bottom. Right, so there is that is what the same. BankNifty also understand 43,000 is clearly conquered with the candle close about that. We still cannot be sure from the price action point of view that we are in the bull zones, but clear indication of a bounce up and bullish move that has happened in the previous week, and it was a very volatile week, definitely, and it also trapped the bulls and the bears. The bulls were not really trapped because the bears was evident before the previous week itself with a very big swing, and we had taken the point that it could correct some more downside, and that's exactly what happened. It corrected some more and trapped the bears and then bounced up. So big volatile moves are seen. Now let's get into and see the daily charts. The daily charts are clearly showing that there is a bottom that is formed here with a double bottom. No moves happen on both indices, and it's certainly a gap up that happened on the last Friday on both indices and with wide range bullish candles, right? So that's also positive double bottom formation, right? And, so let's figure out the details, more details, right? And that's it. So weekly we gained 254 points. It's less than near to 1.5% of up move that has happened, and it's a bullish candle. Obviously, almost like a bearish one. We'll see that, and it is close to above the weekly moving average of 20. Right, and we know that we had recovered from a 3% of dip, which breached the trend line support that had long consolidation over there, and now there is a double bottom pattern that has happened. And it has bounced up from the 20 DM and MI zones. Right? That's the same thing as BankNifty also happened, but the points that we gained is 1,150 points. Of that's 2.86% of what has happened. That's the pattern that's formed and the closing of about 2050 moving average in the trend line breach and the comeback. All the same, except that the trend line breach is not fully recovered in BankNifty. Right? Because BankNifty did a deeper cut of 5.5%. It does not fully come back above the trend line resistance that we are talking about. This is what we are talking about, right? So BankNifty has successfully cleared and moved above the trend line, and the Nifty has successfully moved above the trend line from where it had slipped down, but BankNifty has moved above that on the budget day volatile moves, but on the the closing basis, it's not done that, and that should not be a big deal because it's almost at the top of that trend line is what we are seeing. So on the daily time frames, so what has happened is it's a 1.38%. That's 244 gap up gain that has happened on Nifty, and 2% of almost 830 points of gap up gain that has happened on the BankNifty, both closing greens and bullish candles. The thing is, the price is closed still below the 20, 50, and 100 daily exponential moving average. We're talking about 20 weekly moving averages there on the top in weekly analysis, but daily 20, 50, and 100 DDA Demat supports are still not conquered, and BankNifty has conquered 100, but 20 and 50 Demas are still right above their resistances. So that's going to be leaving behind a lot of uncertainty in spite of this bounce back. And as to whether it would be it would move above that or not, so until that is clear, we cannot get clarity. Now, it is managed to bounce above the Fibonacci retracement levels. It is, remember, it had reached the Fibonacci 61 retracement levels and then exactly bounced up on the Nifty, and then BankNifty also just reached the Fibonacci 61 retracement levels from the previous single and then conquered that. Right? That's a kind of pricing. So we expect to see very good bullish moves, but we still not, we just cannot completely cover the kind of big falls that happened previous week. But still, we did fall further down because of the negative news that came in, but we still cannot have 100% clarity from the charts whether it has recovered completely from that, and it's too big a target to completely recover and exactly next week itself when such big downfalls of 3 to 5% of downfalls happen. So that's where we are. All the bands still indicate that we are in downfall. It is still not climbed above the 20 moving average, above on the daily charts. If you see, the Bollinger Bands still has got the downside expansion, which is negative in base. It continues to be there. No contraction is confirmed yet because it's still a sliding down on the bands that we're seeing there. And this we are already seeing. This is the famous trend line that we have been talking about multiple times and multiple weeks and months now. And then it was breached last weekend, but it has successfully climbed back and then closed about 20 weekly moving average also. And BankNifty also just bounced up beautifully from the 50 weekly moving average, and then almost there at the edge of climbing above the trend resistance where it had consolidated and taken support earlier. So look at the support resistance levels right here on this chart. The first support could be this Fibonacci 50 support, supports that's appearing near 7800 nearby zones. So it could be a good support now that it is conquered and a close has happened about that. If that is breached, then it come back to the 17761, and then the major support would come in as Fibonacci 61 support, which is at 17569 and 17500 is very beautiful levels. Now, if that is also getting breached once again, then it will go back to the 17300 zones, which is also the previous swing low as well as the gap support. A very good gap support could act there as a good support there. So 17300 is the support's bottom side watch has to be there, and similar in the on the upside 17959 would be a previous swing high. Resistance that would land in Fibonacci 380, it's there at 18,000, 18,070 zones, and that could be a resistance. 18,000 clearly is a resistance to immediately look for after that. 18,140, 18,202, and 18,262, and 18,262 above. If the price moves up, then we can say that yes, that's done with. The bottom is made there, and we have a breakout, and then the rally could continue from there because price action wise also that's still our high place. Right, so making all of these levels. Supports and resistance on BankNifty. Here, resistance immediately would be at 41,486 zones, which would be the Fibonacci 38 levels, and after that you have 41,835, and then 42,231, and then Fibonacci 23 comes at 42,566, and then you have 43,000, which is very crucial lower high zone for the price action from where we can come from breakouts. Similarly, downside the supports will be, the first one will be Fibonacci 50, which is breached and bounce up happen from there at the 40,800 nearby zones, and after that, if that's breached, then 39,990, 40,000 zones would be the Fibonacci 61 retracement, which is a previous swing low nearby zones also, and if that is breached, then you go back to the previous swing low that was made, and then you can see the supports at 39,750 and 39,200. So 39,200, 39,000 rounding number would be the zones where the lower side could be looked at for the bank nifty, and the upper side could be looked at 43,000 if that is concrete, and we can say concrete. So until then, that happens, it may be consolidation that may be happening if the price moves around this duck zone of 43,000 and this 39,200 cents. So until that's reached, it remains sideways is very sure. And that's what Bank Nifty is support and resistance is on. Moving on, we are looking at the momentum and the trend indicators. The momentum of the weekly is what you see here on the left side on the Nifty and the Bank Nifty. You can clearly see that it is a compact and the momentum is rising up, but the momentum is still in the sideways and rising up. Right? But on the daily charts, the Nifty and the Bank Nifty that you see on the right side, you can also see that the big momentum up move has happened, and it has climbed back to the sideways zone from where it had fallen down the previous week. So that's a big comeback that you can see at the momentum. But as of now, the momentum remains sideways and rising up in both the time frames and both the indices. Now looking at the ADX indicator that we are using to capture the momentum, the weekly time frames, you can see that the Nifty and the Bank Nifty, both of them it has not crossed out bullish zones at its in the bearish zones, but a cross over to the bullish zones has definitely happened with a big bounce up that has happened on the short time frame. ADX has turned out to be positive and bullish on the short term, but not on the longer term yet. So momentum has picked up and climbed back to the sideways from the bearish zones in the short term, and and sideways again on the medium term as well. So that's a summary of the momentum and the trend analysis for the analysis too. Right. Moving on, the volatility and the opportunity analysis, what we are going to look at. Volatility indicator, the creed indicator, what we call the index in the India VIX is cooled off against 17%, but remember that we had 26% of fall that happened just the previous week. That's a kind of volatility that you see in major events like the budget, and that too is combined with negative news flow from the Adani stock crash. So that doubled the volatility and shot up 26%, but this week it has cooled off, but you have still to be cautious that this kind of spikes, there's no confirmation that it's ended up here. It has come back to the 14.3, which is the lower reaching, but definitely stay out of the trade if it's again spiking above the centimeter. It's about the 20 kind of levels once again, right? But VIX in control as of now. The sentiments have cooled off, right? That's what I'm saying. And moving on, the open interest data, that's very interesting, right? It's very bullish actually. So it's a short covering rally that we may be seeing the next week, because that's what the build-up happened on the Friday on the option on the Nifty and the Bank Nifty futures open interest data. That short covering would mean that the people who have gone short is now covering and they're taking long positions, and that could be gigantic pullback that could happen, right? We never know. That's the build up on the Friday. And if we're talking about the options open interest, that's for the February 9th 2023 weekly expiry, the second weekly expiry that's coming for the month, and the put call ratios for that is bullish. 1.1 is bullish, that's for the Nifty, and 1.08 is also bullish for the Bank Nifty. So open interest data definitely bullish, which has cooled off, that is also bullish. Now let's look at the open interest options levels for the indices. Have a quick look. Look at this. It's a support that's built up more than the put writing is built up is more than the write up from the call side. That means the market is bullish from the options analysis point of view, open interest point of view. So look at these levels: 17,600 and 18,000 is where the highest put and call writing is. So 18,000 is where the highest resistance expected by the option writers, and 7,600 seems to be a solid support zone that the option writers are thinking that it may not get breached. Look at the next support level. So 17,700 and 18,500. That's a very wide range, where the highest second level of highest put call and call writing is seen. And PCR we already seen is bullish, and options futures OI short calling is also bullish. For the bank, if you look at this, 40,500 and 43,000, that's more volatility is expected by the option writers. Highest put and call writing is seen at 40,500 for resistance. So this levels of 18,000 resistance and the 43,000 is in par with what we had been talking about from the charts as well. So it's in sync bottom side also 40,500, 70,600 are all support zones on the charts as well. So second highest put and call writing is seen at 40,000 and 42,000. Highest put and call is seen second. And 1.28 is BankNifty also is bullish and short covering again seen on the futures side and the BankNifty. So definitely a bullish but a volatile BankNifty operator. This is what can be studied from the charts, from the data that we have analyzed. Let's move ahead. So it's about this how the industrial sectors performed last week. It's a mixed bag performance that has happened. You see, the IT has done well, the auto sector has done extremely well, FMCG also has done very, very well. Look at the moves and upside that has happened. 3.5% up in the FMCG and auto, 2%, more than 2%, 2.1% up, and IT 2.8% up. So auto and FMCG from the momentum perspective on the medium term and the short term is clearly bullish. It's a wide range bullish on the daily charts and it's momentum bullish on the medium term as well as short term. Right? So long trades can be tried on the auto sector and the FMCG. Momentum long trades can be taken on the sectors, auto and FMCG, and IT is yet to catch up on the weekly. It's still sideways. Once that is also clear, then that's definitely going to happen, is what the charts are showing. So, but the metal was a stock that was a sector. It is a sector that got hit back huge. So metal 7.7% down. Right, and after that, pharma also did back 2.5% down, and the reality also was kind of flattish, less than 0.5% down. So inverted hammer could be for indication of a bottom being found in what reality is. Let's go to the charts and see more. So ID sectors, you can see it's clear up move that is happening towards it's approaching a previous resistance zone, and we'll have to see the momentum, whether the momentum will be able to climb back on the bullish zones on the weekly or not. We'll have to see that. But look at this metal on the downside, big crash for some reason. Metal has got some connection with the mining stocks, probably. I would assume metal and mining. So it is a big crash that has happened, and remember we are in the all-time high at the peak when it was a breakout was almost about to happen, and then it failed and was about to fall down big time, and the momentum has slipped to the sideways. On medium term, the trend has turned up completely negative. That's what you see. But look at this auto. It has steadily been rising up since last 4, 5, 6 weeks up towards, and now it's once again at the frame resistance zone of the all-time high nearby zones, and momentum also climbed into the bullish zones. Trend is also turned positive, but the thing is, this is crucial. It could again make zigzag movements sideways and move towards the bottom. So we'll have to keep close watch on whether auto will be able to break out, but as of now, it's bullishness in the evident. Pharma has fallen back in the channel from where it attempted to break out from the trend line. It has failed, and now it's back to the bearish zones, and bearishness is increasing on the medium charts as well. FMCG, just like the auto, is also breaking out, and it's a crucial rounding pattern also is there. On a weekly basis, it's turned bullish on the momentum and turned bullish on the trend indicators as well. But one thing is, it's again back to the very crucial all-time high levels. So resistance could be expected in the auto and FMCG both at the same zone. So keep a close watch on these two sectors. The reality has been some consolidating at the support zone from where it had broken down and then fallen back, and then so that's neckline zone where it is. This inverted hammer could be an indication that the bottom is made, and from here it could move further also. It's at the momentum support of 40 also, but there is a cloud of bearishness out there. So the clear winners are the IT, auto, and the FMCG. From the comeback rally that has played out last week. And moving on, the 7 industry, the index heavyweights, if you analyze HDFC Bank, in spite of all the drama that has been happened, look at this momentum. The momentum has never gone below and fallen down into the bearish zones, and the beautiful momentum divergence has played out and has met the target also and bounced from there. It's a range shift of the momentum plus divergence that has played out beautifully, and it's a flag pattern that is there, and the breakout from here could be huge. But the only problem is that we're still in that bearish zone where it had all-time resistance is at 17,000. We're still in that zone. So until 1726 kind of levels is breached and the breakout happens clearly on that, there is a big probability that it may not sustain. But definitely bullishness is evident in the HDFC. Same as the bank in the HDFC also, not just in the bank and the finance arm also. You can see that momentum is bullish, trend shift has happened, divergence is there, flag pattern is there, trend and momentum both are in the bullish zones on the indicators, and that's it. So HDFC twins are doing good and bullish zones. Reliance has been zigzagging and it's in sideways momentum. It's almost breached the momentum, but it's in a rectangular pattern where it's in a neckline or a breakout, and it's less likely that it will breach this zone. It will hover around this and then gathers a bit of energy to move up back to the 2800 once again. Right now it is at a support zone, major support zone. Any breach from here could be fatal, but that's unlikely to happen because it's at a momentum and a price support zones. Right? That's what Reliance sideways. Look at the two IT stocks in first and TCS interest. Interestingly, there is a breakout that is almost confirmed on the TCS, and it is breakout of the trend line, and momentum is climbing the bullish zones on the weekly as well. In the case of TCS, and the trend is also bullish. So, definite time to put your bets on the TCS. Infosys has got a lot of hurdles to climb before it can be fully bullish. It's also having a sideways momentum rising, but remember we had a frame the very zone where it had met resistance 3 times earlier, so all eyes has to be closer there as to whether it would succeed to breach that gap resistance out there or not, right? So I definitely bullish at both of them, but if he is facing a resistance right about there, so you got to be cautious, but confirmation of a breakout on the TCS is visible there. Now ICICI Bank has taken a momentum support at RSI 40, and it has bounced a big time last week. The big comeback was primarily led, the bounce up was primarily led by the ICICI Bank, which has look at this candle. It's a wide range bullish candle with a beautiful bounce up from the momentum, and the question is whether how far is it from making it at an all-time high, or would it be able to climb back to the bullish zones ever or not. And if that happens, it would be a breakout of ascending on the other side, ascending wedge. It was almost about to breach the ascending wedge on the bottom side. Now things have turned up, and now all eyes be as to if this bullish bounce up could sustain above the previous week's candle high or not. Right? Kotak Bank, as usual, has been doing nothing but going sideways, but managed to make a good green bounce and then get back to the sideways momentum zones. That's what. So, laptop IT stocks doing good. As is a bank, big comeback. HDFC twins remain bullish. Reliance sideways. That's what industrial heavyweights are doing now. Let's analyze and see how the institutional participation in the in the markets happened last week. It's at 14,443 crores of selling is what happened for the Fyers. But look what different DIs are done. Domestic institutions found this an opportunity to buy at cheaper price and then bought almost an equal amount. 14,200 crores of buyers happened by the domestic. So who held the market from falling further last week? Who created the bounce up? It was only the domestic institution. The buyback has come from big mutual funds and big corporates, big domestic institutions like LIC was bought in and supporting market when FIS continued to be sellers, big time sellers. So they increased the selling when the budget news and the Adani news came in. The selling intensified is a worry, but the DIS held market. So even now, even while we have a green close and a bounce up and a balanced institutional participation and all that, the worry still remains for the FIS. So how long would FIS remain as sellers and not actively participating in the market? So that's still a concern. No, that remains. Now, the next section would be analyzing the global markets and the global commodities. First, the global commodities. It's about gold, crude, and USD INR and all that, right? So the currency. The first thing we look at. Currency is tracked by the USD INR currency pair and the US dollar index. So USD INR, we can see that it is a week where 1% up move happened. So rupee is weakening once again. It gave a hop of a double top breakdown, but didn't happen, and it has bounced back once again and heading high. And it is at how much is that price? It's a price. It's 1% up. So it's 82.43, and that's not good news. But look at dollar index charts for which is that down here. Dollar index I was giving a lot of hop, but it also has formed a hammer and seems to have some intention of hanging on to this neckline zone, which is breached and which gave the hope that the dollar would further release and cool down from the 2-decade high that it had made several months back. Now, so the climb that has happened is almost equal. 1% of dollar index move also has happened. It's 102.9, far away from the 2-decade high of 115.20 that zones, but this is not good. That the rupee is not weakening and the dollar is also shooting up instead of further cooling off. Right now, the next thing is the U.S. markets. So now that we have seen that the dollar is moving up, is not good. Rupees remains to be the weak zone, so it's not good. Now the global markets is we are analyzing only the U.S. indices. We are not looking at the Europe. So also the Europe also seems to be breaking out and breaking out and then coming up and recovering from the resistance is what the European markets are also showing. But we'll analyze the mother market, the US markets, indices and Dow Jones is indicating that it is even a flat close exactly at the top of a trend line resistance zone of on the top of it. Right, momentum is still sideways and has not managed to climb into the bull zones yet. Right? Now, looking at the Nasdaq, it's slightly different from. It's also at the top and seems to have taken a breakout, but it has got a major resistance run down there at the 12,932 kind of levels. Right, so that is still not conquered, but definitely very bullish, rising momentum up move. Attempt to break out of this wedge is what is seen, and Nasdaq is way above the Dow Jones and S&P index. The broader index of the US market is also seems to have broken out from the descending wedge and then trying to trade out the next resistance at 4244 kind of levels, and then so momentum is all of these are sideways but rising and almost very close to the uh, very close to the RSI 60 above bullish zone. So it's in a very crucial zone. So we never knows what to happen. But unless and until we see a solid breakout with a green close above this, we just don't know whether this was real or not. It could happen that it could again consolidate here for a long time, or it could also happen that it breaks down and goes back to the low of the wedge and then from there it again bounces. All these possibilities are there, but right now it's a crucial breakout zone on the top of a descending wedge and US markets are green. Crude oil, it's good. It has come back below 75, 73.35. It's a big fall on the crude. How much was that fall? It's 7%, 7.5% of down move that happened after last week. It's in sideways and it's a relief. Gold, definitely the market is recovering. The gold would not for the breakout. This is exactly what has happened. So there is a big fall of 3.3% down after nearly 20% of up move that has happened when the markets were struggling. Right, so gold still in the cup and handle pattern, and this indicates that there could be further fall down towards the bottom and make another zigzag movement of the handle part of the cup and handle. So gold is still on the edge of breaking down. It's still bullish. So unless and until you have a new move down below this current weekly candle next week, if that is confirmed, only then we can say gold is not trying to make so gold is hedging is going good. When the market is not going good, gold is going good. Now the market is going good, come back, gold is taking a hit back. So people basically switch the money from gold into equity into gold. This is what happens, and that's what we have to assume. Right, so commodity wise, you see it's good. The crude has fallen. From the currency point of view, it's bad that the rupee is not appreciating yet, and dollar is rising up. And from the US market point of view, it's green, but it's very crucial resistance zone that they are at. Right. That's about the analysis of the global markets. Right. Now moving on to stocking for the next week. One is ITZ, the stock that everyone is ignoring. Everyone's laughing at because of lack of move. Look at the candle, look at the breakout post purchase that has happened. 381 nearby zone is what the ITC is at. It is a big breakout from a small down retracement that has happened to the neckline from the breakout zone. A very beautiful pattern is seen there when the breakout has happened. Now, there is also a weekly negative divergence. So divergence, which is bearish in nature, is there. So to be cautious on that. Now that such a big move has happened, the trade should not be after the high of this week's candle high. No, it may not work out. So we can expect some kind of retracement or some pullback, some consolidation can happen. So the moment you see that consolidation forms a pattern or a pullback that happens, that's the time where you have to make the entry. Not so this. So it's a pullback trade opportunity that could be there, but clear bullishness in the ITC. It's a long trade opportunity. It's a position as well as a small swing trade. But if it is small swing trade, the entry has to be at the retracement on the pullback levels. It's a pullback trade. Mahindra the next week, it's auto stocks are at the all-time high levels, at the breakout zones. And look at this, it's a rectangular pattern, it's a flag and pole pattern, and it is also having a negative divergence. You have to be cautious about it on the weekly, but a rectangular pattern has drawn a breakout confirmation, and small swing trades could come in. But keep tight stop loss below this week's low. That's a trade. Long opportunities on the Mahindra, the auto sector, and ITC, the FMCG sector, and both these sectors are doing extremely well. The only thing is, it has now that it has already happened, breakout has happened. You just have to wait for some time before you get confirmation on the pullback trade. Same with Mahindra, just have to get a confirmation of a breakout above the candle's high on Mahindra. That's the topics. Now, this is another trade opportunity that you can avail. Right, on the Nifty from the option strategies. So this is a double diagonal counter spread that you're seeing, fully hedged. We know exactly what you'll lose, 20,000. We know what exactly maximum you'll hit, and what is the probability is 75% nearby. And the risk reward may be less, but if you're exiting and targeting for a consistent 1% only, or 1 to 2% only is targeted every week, then this is the trading strategy that is going to get you that. It may not give you big gains, risk reward may not be great, but it's a non-directional strategies, and it gives you very good ranges. Look at the range, 17,400 and 18,200. That's the range that you want. Market is not likely to breach that, and if you don't breach, you just can draw up and draw down the hedging legs on both sides. It's completely risk defined and is consistently performing strategy. Double diagonal spreads where you are selling the near month put OTM put and OTM call, and then we hedge it with 4 month OTM put and OTM calls, for OTM calls and for OTM puts, right? So that's double diagonal counter spread. Nifty option strategy also is another trading opportunity for the next week. Now that we have studied the market end to end with different parameters, let's summarize and wrap it up. What exactly happened last week? So there's a bounce up, and previous to that it was nothing but a crack down, and in between you had a budget that came last week and a very bad tiny group of stock crashing that happened. So market seems to have survived that, and the bounce up attempt is very solid. Market may have digested that, right? Let's hope so. So this is what, in spite of all this, I'm unable to make a clear, solid view on directional. So I cannot say it's bullish or a bearish view. My view is sideways plus with mild bullish bias is what my view is all about. A cautious bullish, whatever I call it, right? Because of the reasons, right? The trend is still sideways, still not bullish. Momentum is still bearish on the medium term. We're talking about weekly charts, and the Bollinger Bands is still in the expansion of the downside. Fyers is still selling. It's not still there upside on the moving average on the daily time frames if we see. So it's all in favor of the bears. But looking at the Fibonacci 61 bounce up that happened, looking at the double bottom that happened, price action that is there, looking at the open interest bullishness that we are seeing, the cool of the VIX back to the lower regime. So all of them make me still think that the market may be consolidating at least, but a big crash may not happen again. The budget positiveness was negated by the Adani news, right? But negative flows, if that's continuing to coming in, then we have problem, right? Some kind of response has come out from the government, and some clarifications from the banks and RBI and all the things that happen. So market might have digested already that, but now that kind of same intensity fall is not likely to happen. Market only knows this has happened, and then that's it, and that's not what the market is all about, right? There are a lot of other shares and other industry, and the business has to move on. So that kind of fall will never happen even if the more bad news force comes in, market may be bearish or may consolidate some more. That's it, right? And if this is done with and this clarity has come back now, and if in case the other issues again comes back, it's not easy to do that when 75% of the erosion has happened. It may take some time for the comeback. So market is likely to uh, consolidate more, no, but not crash. Is what my view is there for the next week. Right? So indexes quickly short of 26% down, 7% up. So quick comeback of the weeks has happened. US market is positive green and trying to break out of the zone, and but it's a crucial resistance zones, and global markets are also doing okay. But the Russian fears, inflation fears are all eased up, but that worry is still there. The uncertainty is still there. All those. So you just have to keep a close watch of the weeks, and if it is shooting up above once again about 20, just stay out of the trade and cut short if you're a professional trader. Right? Cut short the portion size, I mean. Right? So if the portion of the crude is falling down is good, but dollar is spiking up. Rupee is still weak. It's balanced out. It's uncertainty is still there. It's something that we have to be cautious about. Levels to watch is for medium term is 17,300 and 36,800 on the indexes, and the upside 18,200 on the Nifty and 43,000 on the bank. If these levels are breached, then we can have some more hope. Until then, we just consolidating basically, right? Although on a day-to-day basis or a week-to-week basis, you may be up and down. We just may be consolidating until this levels are breached on the upside or downside, right? That's something you have to keep in mind. So that's in my view remains neutral, sideways to with a mild bullish bias, you can say, right? That's a view. So that's a wrap up. So once again, as I usually say, always if you're playing in options and derivatives, have hedge strategies where your risk is defined, where you know what you lose, where you have another opportunity that may come and you have capital protected. Otherwise, yes, you have nickel calls and you're wiped out, and if you have taken it overnight, right? And also when such volatility happens, it's an opportunity for you to buy. When the dips happen, that's an opportunity for you to buy, because eventually the market is going to move up. We know the economy is strong. The International Monetary Fund has certified that volatility needs, so we know the markets will climb up and up on the long term, on the medium term. But short term, you have volatility, and that gives you opportunity to buy in. Invest in SIP, not big, on invest in on quantity stocks alone, right? And also you can do that investment with the help of option strategies, which gives you rental income, which is explained in the playlist videos. Check out that if you don't know about that. There's cash equity, puts and covered calls and wheeler strategies, and all that helps you to continue invested in the market using the options at the same time, generate trading income, rental income, whatever we call it, right? So always hedge your positions if you're taking on that risk. So that's my view for the market, and good luck for trading in the next weekend. In case you are viewing this and if you're not subscribed, please subscribe, and uh, uh, have your feedback, comments all put in there. It helps us motivate us, and we have very few subscriptions, and unless you share or you yourself do not subscribe, there's no way that the quality of the contents can improve by us giving more time and dedication to that. We are already doing that, but we would be more motivated to keep doing that if this is spread across more number of subscribers, right? Also, we have monthly subscription premium services that has started last week. You can check out that, and more things are coming out. Daily videos could come out after a period of pause, where my time and dedication is required elsewhere for some period of time. So good luck, happy trading, happy learning, happy investing. Bye bye.